Hey traders, welcome back to Discount Trader. In today's breakdown, we're analyzing a clean bearish setup where the market delivered a textbook structure break, liquidity manipulation, and a precise reaction from our bearish point of interest. Let's walk through this chart step by step so you can understand exactly why this sell trade played out so perfectly. First, look at how price was pushing lower and then created a clear bearish break of structure. This break of structure confirms that the market sentiment has shifted from a corrective phase into a continuation of the downtrend. Once this structure breaks, we know the market is ready to look for premium prices to sell from. So now my focus shifts toward where the next liquidity pools are sitting above the price. Before pulling back, the market creates a set of equal highs, which becomes easy liquidity for smart money. Price moves up to sweep that liquidity, grabbing stop losses and triggering breakout traders into a trap. This sweep is important because it tells us institutions are collecting the fuel they need to make the next big move. After the liquidity sweep, price taps into a clearly defined bearish point of interest, the last up candle before the strong down move. This point of interest represents institutional orders and inefficient price delivery. This is where I expect the market to rebalance, react, and give us the continuation to the downside. The moment price enters this zone, we prepare for our sell setup. Before giving the real drop, price forms a smaller swing high just below the point of interest. This is inducement, a trap designed to pull early sellers into the market so their stops can be used as liquidity. Price takes out this inducement, taps deeper into the point of interest, and that's where the real institutional reaction begins. This confirms our point of interest is valid, and the market is ready to continue lower. Now let's talk about our target. Below the structure you can clearly see sell-side liquidity, sitting at the previous lows. This is where the market is drawn to, because that's where the remaining liquidity rests. As soon as the point of interest rejects, our expectation is simple. Price will travel from premium levels back down toward that sell-side liquidity. Once the inducement is taken, we get a clean rejection from the bearish point of interest. This gives us the perfect confirmation to enter the sell trade. Stops go above the point of interest, entry inside the rejection, and our target is the sell-side liquidity at the bottom of the range. The market reacts exactly as expected. A sharp drop, clean bearish candles, and a smooth price delivery, all the way down to our final target. This is how institutional order flow aligns with smart money concepts. If you found this helpful, make sure you follow Discount Trader for more clean and educational SMC trade breakdowns.